What is a GST time bar compliance? Earlier, when GST was introduced, there's no such concept of time bar and other things. Of late, again, government is also reviewing every month on the GST council meetings how to fine tune the GST Act and how to improve the GST activities. And recently, in 22nd September onwards, we have seen that a lot of rates have been reduced and compressed to give the benefit to the consumers. Can you make it larger in slide mode? Yeah. So in this GST regime it is more now becoming a technology driven, and also it is more AI dependent. The government is also using AI tools to improve the efficiencies of the GST function and GST returns with the 2A, 2B, 32 and all those things. And every transaction, invoice, as and delay is traceable with the GSTN system, making timely filing and reconciliation is very, very important here. The time bar provision introduced fixed deadlines beyond which business cannot claim input credit. Why the word time bar has come means if you are not put the time bar as a restriction, the organizations can keep on claiming the input credit even after 3 years, 4 years, 5 years, whenever the vendor files the invoice. So there's no discipline in system, and government or the organization cannot evaluate how much input credit you are taking an average in every year. So next slide. And what is time bar? We have three sections. One is section 16 subsection 4 and section 34 subsection 2 and section 37 subsection 3. The first one says prohibits ITC claim beyond 30th November following financial year. It means suppose a 23-24 financial year is there, the government is allowing you up to 30th November of 24, even though the financial year closes on March 24. It is giving enough time for the organization and also vendor to reconcile and file their returns, file the input credits properly. And then section 34(2) says disallows credit notes issuance after the same date. Means after the 30th date, if any credit notes are issued, that cannot be considered in the portal. Section 37 subsection 3 limits rectification of GST 1 and the same cutoff. It means you cannot rectify GST 1, keep on editing, modifying and all those things once the deadline of 30th November is completed. So this is a time where after the March, we can say around 9 months period we have, 9 to 10 months period where we have enough time to reconcile our GST inputs versus our vendors accounts, and then which vendor is filed, not filed, all that exercise we can complete so that before the deadline, the organization can have a benefit of your input credit. Yeah. So the just time bar and financial closure, how it works is year-end closure, financial closure, and GST deadline often overlap. Though we call 31st March as a financial year ending, except the listed companies, the non-listed companies will have time up to 30th September. The audit may continue till 30th September if not extended. Otherwise, it will go up to even 30th November, and this time I think up to 31st October or 10th November they are given. If they keep on extending for some reasons, and our GST deadline is 30th November, which is fixed, then you will have land up in your reconciliations mess, and you will not able to get the proper input credits. You are bound to have a risk of your open input credit. And delayed reconciliation risk ITC before November cutoff, and post deadline impact if invoices corrected after 30th, you cannot be able to enable the input credit. And finance teams must synchronize their audit and GST calendars to ensure all pending credits are claimed in time. It is nothing but calendar in this sense. You must be having a quarterly closure or monthly review or quarterly review. In those reviews, your GST review is also need to be a part of your regular checklist. So that when your monthly closure is there, how you analyze your trial balance with all the expenses are provided, all the income considered, the assets are being capitalized, depreciation is calculated, not similar way. Your GST input exercise also has to be done. Whether all the output is being properly accounted, whether any credit note, debit notes issues have been considered, how the input credit is been factored in your GST account to books of accounts, you have to reconcile that to get a proper input credit availment.